Welcome to Trading the Markets. This is class 3. Let's get into it. Let's run this real quick. All right, my name is Richard Joseph. I'm not a financial advisor, so everything for educational purposes. Good evening. Today we're going to talk about the indexes. Give me 1 second. Pull it up. Thanks for joining, Chrissy.
Hi, Witchell. How are you?
Well, I'm well. You've been learning?
Yes.
All right. Today we'll talk about how to actually get started too as well, so that you can start to put it in practice. Matter of fact, I'm gonna drop my links, my referral links on the chat for anybody to come in if they want to get started.
Noted.
hmm Let's see, hold on. And then I'll share my screen. Okay. Drafts. Okay, so there's two links I'm going to share. One from my Robinhood, and the other one is going to be from my Webull. Those are two good platforms to get started with trading and investing. So here's the Robinhood the chat. Why can't I don't see the chat? It's on the side. There it is. So this one, Robinhood, when you sign up, both of us will get a free stock. So that's a good little promo. So, if you don't own any stocks, you can get started and own something. And then my Webull, copy, paste, paste. All right, so the second link is the Webull. Now let me get into the lesson, and then I can take questions and go more into probably what these platforms look like and what it looks like to trade on them and whatnot. So where's that presentation I have? Hold on. Get it out the way. There it is. I'll just share my whole screen. That way I could navigate. All right, you should see my screen now. All right, so we're gonna go into this lesson real quickly. All right, so call this little stock market indexes. So remember, we went over the S&P 500, went over the 11 sectors of the stock market, and basically when I was talking about that S&P 500, it's one basket that contains 500 stocks in one name, right? So now S&P 500, that's called an index. That's like the big, how would I call it? It's like the big school where everything is in. It's like a big classification, like a big C. I would call it like a C, like index like a C. So there's different C's, right? But they all flow and then as the market. Now, so like I said, the S&P 500 is the major one, but there's several other ones that we're going to go over. So what you got to understand is that in these indexes, in these baskets, some stocks have different weights. Like remember how we were talking about the S&P 500, technology is like 29% versus other sectors? It's like that with the other ones too. So let's get into it. So, like I was saying, it's basically a group of stocks that they represent a market, like a piece of the market, and we use it as a benchmark because let's just say if you're about to go trade, you want to see what is the overall seas. Like it's like you're about to go sailing in the ocean. Is the rubber are the waters rough moving, or are they smooth? Are they strong? Are they weak? By looking at this, you're gonna have a better chance of trading with the trend. So like think about it like a rising tide lifts all ships, but then when it comes down, all ships are docked. So sometimes if the index is weak and you're trying to make a strong move in your stock, it might not go because the whole index is weak. So it's good to check the whole temperature of the whole index. So it shows overall direction and it helps you when you're coming up with decisions. So we talked about market cap last time. Remember, you take all the shares that the company owns, multiply it by the price per share, and all the money that's in the stock, that's the market cap. So we talked about large cap, that's 10 billion plus. Mid cap, that's 2 to 10 billion, and small cap is 2 billion. Because I was explaining last time, like to even get to the point where you can have a stock, you got your business got to be in the hundreds of millions. Because as you see, anything less than 1 billion market cap, that's a penny stock. So larger companies have more influence on the index because they have more weight. So whoever has the more weight, they're gonna swing everything around. If I have more weight, I can swing my weight around, and everything's gonna be swung along with it. So the three types of weighing. So there's market cap weight, there's price weight, and there's equal weight. So for example, S&P 500 is cap weighted because it has a lot of it's a large cap. So remember, technology is like 39%. Dow, we're gonna talk about the Dow Jones. They have different ways of weighing on their price. Like basically whatever the price is, that's actually the weight of the market cap. And then there's something called RSP, which is where everything's equal weighing. So we talked about S&P 500 last time. That's the broad market. You have your top holdings: Apple, Microsoft, Nvidia, Amazon, Meta. Those are the top holdings, and this is the broad benchmark. So if you want to, if I want to go along, like I want to make money off things going up, and if the S&P 500 is weak and it's going down, that is going to fight against my stock that I'm trying to make go up. Give me a minute, Mike. Little Mike in here. So what I was saying is, if when you check the weighings, when you check the indexes, it's gonna tell you, is this a good time for me to go long? Because if the index is looking weak, now for me to go long and make money, I gotta fight against the current. You gotta fight against the current to actually, make money in that direction. So the Dow Jones. So Dow Jones, this is actually the oldest. This is the oldest index. It has a lot of banks. It has a lot of healthcare. So a lot of like the old reliable companies are in there. They call these blue chips the companies. So they're time tested. You invest in a Dow Jones, they're gonna be around. But what I was saying about the weight is that, like, for example, a $500 stock on the Dow Jones is going to be worth more than a $50 stock on the Dow Jones. But remember, when we learned about market cap, the price of the stock doesn't always determine the size of the company. But for the Dow Jones, it does. Okay? Let me know if you guys have any questions as I'm going through this. So Nasdaq 100. A lot of people like Nasdaq, invest in the Nasdaq. The Nasdaq is the top tech company. So they're non-financial. That means no banks are in the Nasdaq, and it's mostly tech and AI heavy. So the ETF that tracks that is called QQQ, triple Qs. So if you type in triple Qs, you're gonna have that one name has 100 of the biggest tech non-financial companies. So that's where you get your Nvidia, your Microsoft, your Apple, your Amazon, your Broadcom for communications. So that's that. So remember, we said we got the S&P. That's the overall 500. Then you got 30 of them, the banks and the oldest ones in the Dow Jones, and then all the tech ones are in the Nasdaq. So you got S&P, you got Dow Jones, and you got Nasdaq. Now we're gonna go over one more called the Russell 2000, right? So this tracks 2,000 of the small cap companies. So this is all the small companies, and this is an indicator for economic growth. So whenever the small caps are doing good, you already know the large caps are going to follow. So basically, this lets you know if it's a risk on. By risk on, that means that things are going up. It's time to put up some trades, time to buy some stocks because things are pushing. So that's called risk on. But so if you look, so therefore, if you're trading, you look at the Russell 2000 and you see that it's pushing, that means it's risk on. that means the market has an appetite for risk and it's ready to make some moves. But then if you look at the Russell 2000 and it's struggling, then you know that now's not the time to really load the boat. Yep. So we talked about the 11 sectors. You guys know about this. So money's basically always rotating. They never take money out of the market. They just move it around. So if you can track the money, you can see where is it moving into and where is it coming out of. So the sectors that it's moving into, you buy calls because you want to go up. The sectors that it's moving out to, you buy puts because you expect it to go down. So there's a lot of other ETFs that the SPY, that's the S&P 500, QQQ, that's the Nasdaq, DIA, that's the Dow Jones Industrial Average, right? IWM, that's the Russell 2000 I was just talking about. Now, VTI, that is just the Vanguard version. This is the Vanguard Total Stock Market Index. So if you're a complete beginner, you want to buy some stocks, you want to invest, just buy VTI, close your eyes, and then you'll be fine because you're investing in the total stock market. So it can't all burn, right? And then RSP, that's the S&P 500, but if everything was equal. Like you see how like 39% of it is tech, and then I think 9% of it is financials. In RSVP, all 11 sectors are equal. So what 100% divided by 11, that's like everybody's like 9% across the board, something like that, right? I just did the quick math in my head. I think it's about 9% times every, because 9 times 11 is 99. So pretty much everything is equal. All right, so like I was saying, so we're gonna use this as traders to determine bias. We want to know are things more likely to go up or go down, or maybe just stay in the middle. But by looking, so what we can do, we can look at the different indexes and compare them. It'll compare SPY, S&P 500 to the Nasdaq compared to small caps. So let's just say like SPY is strong, right? Then QQQ Nasdaq might be strong, but then you might notice that Russell 2000 is weak. So based off how things are moving, you can know now, for example, Dow Jones, okay, that's all your banks and your healthcare. So the Dow Jones is strong. If you know individual stocks that are in healthcare, that are in banks, you can use that index to be like, all right, now it's time for me to get into that sector. Is that clear? Any questions? I'm moving right along. So major events that happened in the market, you had the dot com crash in the early 2000s, 99 and 2000. Then you had the 2008 financial housing crash. Then you guys were alive for this COVID. I don't know how young some of you guys are, right? And then as of recently, it's the AI-led bull market. AI has been just pushing the market up. But the lesson here is that the market always recovers over time. Remember, I was showing you guys a chart last time. Every time it dips bad, it comes back even badder, even stronger. So so what you can do, you compare SPY versus QQQ, like I was saying, identify the strongest index. So one big theme in the market is you always want to look at leaders versus laggers. Who are the strongest one in the group and versus who's the weakest ones in the group. By seeing that, you can sometimes predict rotation because what will happen is the leaders might become the laggers or the laggers become the leaders. So it's really important to look at identify the strength in everything that you're looking at. It's called relative strength. Like how do you compare it? Well, compare it to the index, compare it to SPY. Compared to SPY, this is weaker. And then you take something else, compared to SPY, that's something else is stronger. So that's how you compare, you find relative strength. But I know like you probably got to really see it to really understand because these are just words. But when you see on the charts and stuff, it might be a little bit more digestible. So questions, which index is price weighted, which track. So let me ask you guys, in the chat, right? Which number two, which index tracks small caps? So see if you guys paid attention. Yep. And key takeaways, each index serves a different purpose. They reveal the health of the market, and ETFs allow you to trade the different index. All right. So maybe next time we'll talk about sector rotation and market breadth, but that's it for this one lesson. I want to get into how to get started. So by the way, I dropped my links to my Webull and my Robinhood in the chat just for people who haven't got started, they could get started. And with the Robinhood, if you sign up with my link, you get a free stock, I get a free stock. And I think Webull does certain amount of, I think $20 in stocks too. Yeah. So where's okay, my what I was trying to show is in here. Yep. So getting started. Um so in the account types, there's two account types. There's a cash account and there's a margin account. So the way the cash account works is that whatever amount of money that you put in there, you can day trade that amount of money. But once you finish trading that amount of money, you have to wait till the next day. So, for example, if you have $1,000 in the account, you can do 10 day trades for $100 each, or 2 day trades for $500 each. But it's like once you put up that amount of cash, it's locked up till the next day. The reason why this was good is because there used to be something called the PDT rule, which is pattern day trading rules. So basically, before you wasn't allowed to day trade as much as you want. If you unless you had $25,000 in your account, you were restricted on the number of day trades you could take. So the restriction before, mind you, they stopped this earlier this month, so you don't have to worry about this anymore. But I'm just telling you how it was for all of us who's been in the game, right? So you were only allowed to do 5 day trades. No, you're only allowed to do 3 day trades in a 5 day rolling period. So Monday through Friday, you can only do 3 day trades. And once you went over that, you would be flagged and they could stop you from trading for like 90 days. So can you imagine you're day trading, you're in the trade. I know Mike probably knows about this. You're in the trade, you're making money, but you already did 3 day trades for the week, and now it's Friday. And now, if you do your 4th day trade, you're gonna get flagged. So then, what you do, you hold it because you don't want to get flagged, and then the next day it goes down. So then it's like, damn, you could have sold it, but because of that rule, it made you restricted. But now that's no more. So you can open what's called a margin account. The margin account, it's unlimited day trading. So let's just say you have $1,000, you put it up the first time, you get that $1,000 back to trade again. So I would say if you're starting off, you can do either or, but let's just say you have no control and you're brand new and you don't want to mess up, it would still be helpful to open up a cash account just to put a restriction on yourself. But that's up to you now. So then what I would recommend is focus on one stock and one index. So for example, you can focus on the S&P 500 and you can focus on a stock like Nvidia or Apple or Meta, whatever you want to focus on. Because what you want to do is you want to get familiar. Like if you're completely new, you want to look at it every day and get to know it like it's a member of your family. So like certain stocks we focus on, we were like, oh, I know what it's going to do. It's always going to move slow. It's going to take, or this stock, it loves to take off in the morning. So let me get in early. Or this stock, it likes to fake out. So let me chill. So it's like you got to be it's because some stocks move differently. Some of them move like this, some of them move like this. So you have to get to know its movements like a member of your family. Then on top of that, focus on one time frame as a baseline. But I won't just say one time frame. One time frame as a baseline, but you also need another time frame to time your entry. So you can see a big picture, but then you got to get granular and know, okay, where on this big picture do I get in? You know? So that's that. So now, when you're trading, your mindset. So only thing we can control in the market, and I want you guys to understand this, like this is not gambling. This is trading. So in trading, you can only control how much you're gonna lose. So when I go into the market, I don't be like, oh, I want to make $1,000 today. I mean, I could do that, but I have no control over that. The only thing I can control is how much am I gonna lose today. And once I lose that, I'm done for the day because this is a game, it's a marathon, not a sprint. So so you got to think about this. This is called a risk management because how many losses can you take back to back before you blow before you have no more money left, or before you're down half and then you don't want to trade no more. So you have to be able to take back-to-back losses and it doesn't shake your confidence. All right. So that's the mindset that you want to have when you actually trade. All right. So my process in a nutshell is find the higher time frame. So matter of fact, let me do this in front of you so it actually makes more sense, right? So identify the highest time frame. Let's say, what do I want to trade? Let's look at let's look at Ford. I think Ford is easy, it has easy numbers, right? So let's look at Ford, right? So this is the daily time frame. Every single one of these bars represents one day. So like you can see, like right here on this big green day, that was Wednesday, the 13th. All that movement up happened on Wednesday. But look at what happened the day before. It had a very small move. And look at the day before, it had a still a small move on the way down. But you see the difference in the movement. So if you're gonna trade this, you could look at the daily. You can even like I'm gonna show you the different time frames. So if I go to weekly, now every one of these represents 1 week. So this is Monday, the 15th till next Monday, till tomorrow, you know? And so now on a week, you can see the trend. Like if you look on the week, you see since April 7th, it's been on an uptrend. But if you go back to December 2022, you see it was on a downtrend. So let's just say so then I can even go bigger than that. Now this is a monthly. Every single candle represents 1 month of price movement. So this is for the month of May. This is this month of June. So you see, May we had a very strong month, and June we pulled back quite a bit, right? So but if you look at it from since February, we've been on an uptrend. So you have to look at the market as waves. So like for example, let me explain this. This is how price come on. This is how price moves. Let me erase this. Let's see. So boom, boom. Why is it not keeping going? Oh, it's the wrong one. Hold on. I gotta do the path one. There we go. So price moves like this. Makes a move, comes down, makes another move. It's basically like a staircase, right? Right? So this is the uptrend because as you can see, the highs and the lows are getting higher. But now the way to enter these, you want to enter after the pullback. So let me annotate. So for example, if this is going right here, you don't want to buy right here. No, you want to wait for it to pull back, and then once it starts going up a little bit, that's when you get in because you're catching the bottom of the wave before it goes back up for the next wave. Does that make sense? So you have to identify the structure and enter at the right spot and at the right time. So again, when it's going up like this, you want to wait for it to come down some first and then start to rebound, and then that's when you get in. So these are the best optimal entries is after the pullback. So right now, where are we? We're pulling back. Look, we went up like this, now we're pulling back. So maybe it might make sense to enter, but let's look at smaller time frames and be more precise. So erase this, right? So that's the monthly. So I see the monthly, then I go to the weekly. So you see the week, you can see where it's pulled back. You see where it went up from this week, from the week of the 18th. We're right back to those levels. Then I go on the daily, and now I see how you see it in more detail. It's the same information, just split up differently. So right here, I can be like, okay, this is pulling back. Maybe if Ford wants to start going back up again, I can catch the entry back up, But also we trade options so we can make money if it goes down too. So what I could do is I can make a line and say, okay, if Ford can hold this line, then I'm gonna start looking for the upside. But if it breaks the line and lives underneath, I'm gonna go look for puts to make it keep going down. All right. So now going back to this. Where's the PowerPoint. Which one? Trade process. Yep. So then you draw your support and resistance zones. So you draw your channel. So here's what I do. I'll show you an example of a trade I did, right? And you can kind of see. Where's the forward trade I had? See if I can find it. Not this one. What is it? I had it up and ready. Oh, it's right here. Okay. So look at this, right? So this was a trade I took on Ford back on what date is this? 10, so last year, right? So this call right up where after I take a trade, I document it, I catalog it so that in the future I can go back to it and look at my trade to see if it looks like this. If it's similar to this, then I know what to do. So notice that you see this yellow box right here? That's the support. So right here, let me draw, annotate. Right here. So right here, that's support. Notice that in August, because these are the months, this is August right here, this is September. So in August, it came down to this box and it made a move up. Then what happened? Later in September, it came back to that box, made a move up. Then what happened? In this September, came back to the box, made a move up. Now, after this huge move up, it came down where? To that box. So guess what? I already had this box drawn. So as soon as it came back to this box, because that's the floor, right? And it started to bounce up, that's when I hit it. That's when I got in. But I had to be patient enough to wait, but I also had to pay attention to Ford long enough to notice that it likes to bounce off the floors and it likes to bounce off the ceilings. When it comes to support and resistance, it's very good. Like for example, like you don't even have to be a master of this, and you could tell by just looking at it, like eyeballing. Like if I go to stop annotating, right? So if I go to Ford, let's go to Ford chart, right? So look at it. Look, I'm gonna show you. Look at this and draw some boxes. You see this? Floor. See this? I'll draw another box. Ceiling, right? And then I could even go back and see many examples because remember the floor is not only it's not only horizontal, it's also diagonal. So look, right here, you see it held the floor. Oh, draw this. Right here, it held this as the floor. You see from right here, it touched it right there, and it touched it right there, and then it finally broke through, but still kind of held up before it held the floor. So just by looking at it in the past, I see that, right here, perfect. I think this was the one. Was it the one I entered? No, this was even before. So look, you can see clearly there's a floor. You see that? Clearly there's a floor. And when it hits the floor, don't think just that's your buy zone. Buy it. Because if it breaks underneath the floor, then you're gonna get stopped out. You put a stop loss here, you're stopped out of the floor. All right. So that basically concludes my lesson. I don't think I had anything else on this. Let me see. Yes, yeah. Okay. So when you actually enter, you want to pick a lower time frame. So when you're actually gonna get into the trade, you go in a smaller time frame. So, okay. So let's just say if I want to get into this trade, right? I see that this is a possible floor right here because you see, like from before it broke from here, but it might even come down to this other floor and keep going down, but we don't know yet. We don't know if it's going to keep going down further or if it's going to hold. So if it holds here, I can plan an entry. So I'm on the daily. I would come down to the 1 hour. So now every candle represents 1 hour. So that daily is basically six candles in one, 7 candles. Yes, 6 candles in one. This is 6.5 hours in the trading market. So here I can be like, okay, I can see it clearly. I see right here it's bouncing. This was like a little floor right here. So I might be like, okay, for me to get in, I want to see if it's going to hold this level. But if it doesn't hold that level and breaks it, I might just trade it down to the other floor. So you got to market your areas of where you want to get active. So trading is not just Oh, I see a movement. Let me get in. Every time I see movement, get in. No, no, no. Trading is I have a plan to get in, and I'm gonna wait for everything to line up with my plan before I get in. That makes sense? So I see this right here. I'm not gonna just rush to get in right here. I'm gonna wait to see if it comes back, if it stays in, and if it pushes forward. So basically I'll wait for something like this. Let me go to path. Where is it? Yeah, it's in here. Where is it? Here it is. So maybe I'll wait for something like this. Come down here, try to hold this level. Even if it comes up underneath a little bit, as long as it can hold this level and starts to go up, I'll take it for an entry. But I gotta wait to see if that actually happens or not. But this is something where I might wait. Maybe you'll go a little bit underneath, but come right back up just to trick you, and then you can get an entry. Or maybe instead of doing that, it just keeps going down. But I'll leave this on my charts and see what it actually does come tomorrow, and that can give me an entry. So now, when it comes to trading options, right? So I'm gonna go on Robinhood and show you what I could do, right? So right now, Ford is at 1405. Yeah, right now on the small time frame, it's on a downtrend, right? But I'm trying to see if it'll reverse. So if I go on Robinhood, right, and I go to Ford, you go to Ford F. So this is what Robinhood looks like. This is like how much money I have investing right now in the Robinhood. Um, but let's go to Ford. This is what you call the option chain. It's gonna look really confusing. So it shows you a line chart of Ford. Then you come here and you trade Ford options. Click on that. And it's going to show you an option chain. This is called the option chain. These are all the different options you can buy. On the right, you see strike price. That's the actual price. Remember, options, you're locking in a price. So let's say I want to lock in this $14 price right here. I can buy and then mind you, this is expiring Friday. You see so the first thing you want to look at is at the very top, the price of Ford. Then you see it says buy or sell. We're going to focus on just buying because you can also sell options to open your position, but we're just focusing on buying, right? Then you choose call or put. Remember, puts make money on the way down, calls make money on the way up. So now let's just say I think it's going to go up, right? So I can buy the $14 call, locking in the $14 price. So now if I buy this, it says 33 cents. Remember I was explaining this one time. 33 cents, that's for one share. But when an option contract controls 100 shares. So to buy this, it's actually gonna cost me 33 bucks. It's actually gonna cost me 33 bucks if I actually want to buy this. All right. Because if I were to say continue and I do one review order. You see the price? 33.04. So it's actually cost you 33 bucks when you see 33 cents. So now, let's say if I were to buy this, so I'm gonna add this on my watch list and I'm gonna show you how price would move. Do you watch list? So the beauty of Robinhood, you can put your options on a watch list and just watch your option, not just watch the Ford chart. I could watch the $14 call chart so I can see if it's at a good price for me to get in. So this is the $14 cost. So you see it ended there at $33. But look, on Friday it started at 29, went up to 32. Then it came all the way down to 22 at 1050. From 1050 to 1035, it went from 22 to 33. That's a good move. It might look like, oh, that's only 22 to 33, that's only $9. But you got to think that's per contract. So if you buy a lot of contracts, you get $9 per contract. So if you added 100 contracts, it'd be $900 in profit. That's that's the example. So now let's just say price moves. I got about 5 minutes left in this. So now let's just say by tomorrow the 22nd, and so this is showing me the time. So let's say by 11 a.m., right? So after market opens. So if Ford were to go down and I was wrong, let's say, see, it's at 1470, let's say it goes all the way down to 1350. I'd be down $27 on that on that 32 that I put in. So that's basically down almost the whole thing. So what I paid 32 to would only be worth $6. You see 6 cents. So it shows that's what happens if it goes against me. But now if it goes in my direction, I'm right. Let's say go to 14.50, I'd be up 24 for 24 bucks, 73. So I'd almost double my money. Remember, I paid 33 for it. So it would go from 33 to 57. So that would be a nice gain right there. And if things were to go to like really crazy to 15, I'd be up $67 off from my 33. Remember, I only put in 33 to buy one contract. So now I would go to $100 for the contract. All right. So that's the thing about options. Not only does it need to go up, it needs to go up in a certain amount of time. All right. So that concludes that lesson. Any questions? Any questions, y'all? No? All right, then we can just look at some stocks. Any stocks you guys want to look at? We got about 3 minutes.
Oh, oil's already red again. Funny enough.
What stock?
I was just saying USO is already red.
Oh, USO? USO's already
It's already
red.
back down red.
Oil went
Oh,
back down.
you might not see it on TradingView, yeah. But
Oh, I gotta go to after hours, right?
or look at Robinhood at least. Maybe you can see it on there.
Oh, 'cause 24 hours.
Yeah. I'm gonna text Scalper Betty right now.
All right, let me see.
He's chirping about that.
So, United States Oil Fund. So, with the war in Iran, oil has been going crazy. They was talking about peace, so oil has been coming down. But yeah, we see it's down overnight. If I look at it, you can see where it's been all week. You see, at one point it was at 125, now it's at 114.
Yeah, SPY's almost flat. Yeah.
So depending on so there's no has there been any war news over the weekend? I haven't been paying attention. Nah, nah, you know of.
I don't know. He posted a bunch of random shit. Yeah, there was a bunch of shit, but it's
Hmm. Let's see if
you
any of
know,
them really
it's
move the
back
market.
back to regular.
Because the market
Yeah,
forgets real quick.
market was down. Now it's flat,
Let me look at spot.
but 5.10 negative. But yeah, man, that's it. I'm not watching much.
Yeah, yeah. I like to not hold positions over the weekend unless I'm really swinging
Yeah,
something. Yeah, so yeah, I see it came down from 750, 745. So it's just
not much.
yeah. So by the time market opens tomorrow, we're gonna see where we really are.
Yeah,
Yeah. Well, that's it for today, guys. Thank you for tapping in.
yeah, good shit, man.
Yep.
Good explanation on IWM and DIA,
Hmm.
all that good stuff. And yeah, good
All
shit,
right.
man. You did a
Yeah,
good job
yeah. Happy trading this week. This week I'm just gonna focus on my strategy, just hit it consistently and not chase the market.
for sure.
Mhm.
100%.
All right. Well, have a good night, y'all. Thanks for tapping in. And
Yes,
I'll
sir.
see you guys next Sunday. Bye.
Okay.